Welcome back, Focus Learners. I am absolutely thrilled you're tuning in to today's explainer, because right now, we're putting on our surgical gloves. We are going to conduct a full, no-holds-barred autopsy on exactly why so many new Forex traders watch their accounts get completely liquidated. You know, we hear the horror stories all the time, but today, we're moving past the rumors and looking directly at the evidence. We're going to dissect the mechanical, mathematical, and psychological errors that are quietly destroying beginner portfolios.
Okay, let's dive into this. 90%. 90% of retail traders fail and completely blow their accounts. That is a staggering number, right? It's basically the elephant in the room that all those flashy social media marketers absolutely do not want to talk about. But as a focused learner, you've got to confront this head on. Because this isn't just bad luck, it's a systemic failure across the board.
Which brings us to the question staring right back at us. If trading is so immensely profitable, why are so many people still losing? Well, the problem isn't that the market is somehow rigged against you, and it's definitely not a lack of technical data or fancy charting software. The core issue is a fundamental misunderstanding of how professional market mechanics actually operate. You're out there playing one game, while the institutions are playing a completely different one.
So here is our roadmap for today. 1. The Holy Grail illusion. 2. Trapped by technical illusions. 3. Mathematical ruin. 4. The psychological mirror. And 5. Becoming a professional. Let's get into it.
Starting with Part 1, the Holy Grail illusion and escaping educational gaps.
Pips, lots, spreads, leverage. We all know these are the absolute building blocks, right? The fundamental language of the market. Yet, what we see time and time again in these account autopsies is that beginners consistently skip mastering these concepts. They want that immediate reward, so they jump straight into incredibly complex, advanced strategies without really knowing how leverage is quietly multiplying their risk behind the scenes, or how a suddenly widening spread can just snipe an unexpected stop loss.
It's wild, but retail gamblers will literally waste years searching for some secret indicator or a hidden, quote-unquote, illegal strategy that'll just print money automatically. They actually think the edge is in the tool. Professional traders, on the other hand, understand that the edge is entirely in the trader. A true pro can be profitable looking at a completely blank chart because their edge comes from their consistency, their risk management, and their process.
Moving to Part 2, trapped by technical illusions and the misunderstood charts.
Now, what's really interesting here is the stark contrast in patience. A retail trader sees the price enter a zone, a so-called setup, and boom, they immediately jump in, totally terrified of missing out. The professional? They literally just sit on their hands. They wait for actual confirmation, like a change of character or CHO. They require structural proof that large institutional orders are actually stepping in before they risk a single dime.
And then there's the time frame trap. I see this glitch constantly. Beginners try to scalp a frantic 1-minute chart, but they have absolutely zero understanding of the higher time frame narrative. If you don't know the daily or the 4-hour bias, you are flying blind. You just end up repeatedly taking lower time frame trades directly against the massive smart money trend, getting totally crushed by the market's true momentum.
Let's walk through exactly how this trap plays out chronologically. Step 1. Retail traders see a simple horizontal support line. Step 2. They excitedly enter the trade, putting their stops right below that line. Step 3 is the trap. A sudden liquidity sweep pushes the price down just enough to trigger all those retail stop losses. This acts as inducement. Finally, in Step 4, now that smart money has collected that liquidity to fill their massive orders, they expand the price in the original direction. The retail trader was literally just fuel for the fire.
And you know, this trap is totally compounded by analysis paralysis. The beginner's screen ends up looking like an absolute laser light show. They're juggling RSI, MACD, and like 5 different moving averages. But these are lagging indicators. They only tell you what happened in the past. Relying on this indicator overload completely blinds you to the raw price action and the true hidden engine of market structure that's playing out right now.
All right, Part 3, Mathematical Ruin and the Math of Survival.
Your stop loss is quite literally a seatbelt. If you skip putting it on, sure, you might survive a few drives, but eventually you are going to have a catastrophic crash. Beginners tend to view hitting a stop loss as a personal failure, like the market is insulting them. Professionals view it as a strict survival tool that simply ensures they have capital left to drive again tomorrow. Skipping it is usually the single fatal event that blows an account. Think of trading as just drawing marbles from a probability jar. Imagine your strategy gives you 45% winning trades, 45% losing trades, and 10% break even. Beginners treat every single trade as a life or death event. If they draw 2 losing marbles in a row, they panic and totally abandon their strategy.
They just lack the statistical proof to understand that over a large sample size, say 100 trades, that strategy is actually highly profitable.
So, the crucial point is how you calculate risk. The retail trader is out there guessing position sizes based on a feeling or just wanting to make a specific amount of cash that day. The result of a losing streak? Catastrophic drawdown. Now look at the professional. They're calculating risk as a strict fixed 1% of their account balance. The result is pure survival. A string of 5 losses barely even dents the account.
This mathematical misunderstanding naturally leads right into the treadmill effect. Ask yourself right now, are you mistaking being busy for being profitable? You're taking dozens of trades a day, staring at the screen for 10 hours, but your equity curve goes absolutely nowhere. You're sweating on the treadmill but haven't moved an inch. The truth is, professional trading is highly repetitive, incredibly structured, and honestly, it's a little boring.
That brings us to part 4, the psychological mirror. It's time to face your internal glitches.
A massive part of this psychological failure stems from completely unrealistic expectations. We are constantly bombarded by fake gurus selling these wild lifestyles, living in the Burj Khalifa, driving supercars everywhere. This plants the toxic idea that you should be pulling in 100% monthly returns. Let me tell you right now, chasing those kinds of insane, unsustainable numbers directly leads to over-leveraging. And over-leveraging? That leads to guaranteed liquidation, every time.
It really boils down to emotional reflexes versus neural clarity. When a trade goes sideways on a retail gambler, they react with intense fear. They close winners way too early, or worse, they start revenge trading to try and immediately win back a loss. A professional operates with neural clarity. They feel those exact same human impulses for sure, but they have a thinking system that turns that raw emotion into a calm, mechanical process.
And how do you actually achieve that clarity? Through ruthless accountability. You absolutely must track all your data to identify your own human glitches. You need to definitively see which setups are actually profitable over a large sample size. This means using a proper trading journal, like EdgeWonk or EdgeFlow, to act as an objective, daily referee for your behavior. Because without data, you aren't trading, you're just guessing.
Let's move to part 5 and see how this all builds into becoming a professional and charting your path to consistency.
True consistency requires a fundamental shift in how you view yourself. You've got to stop relying on finite willpower, because willpower always breaks under the intense stress of the live market. Instead, you have to build a mechanical system that becomes a core part of your actual identity. You aren't just trying to trade. You are a disciplined professional trader. When the system becomes your identity, the system does the heavy lifting for you.
So what does that transition actually look like? Well, here's an actionable roadmap to get you out of that retail gambler mindset. Week 1, go back and master the absolute market basics. Learn the language. Week 4, strictly adopt a 1% fixed risk strategy. Stop the bleeding. Week 8, master market structure. Understand inducement, higher time frames, and waiting for confirmation. And by week 12, commit to and complete a 90-day psychology and journaling challenge to literally rewire your brain.
I want to leave you with this provocative thought to close out our explainer today. Will you continue searching the internet for a secret indicator, hoping for some magical shortcut? Or are you finally ready to do the real work and master yourself? The market is waiting for your answer. Thank you so much for joining me on this deep dive, Focused Learners. Take these insights, look at your own charts, and start building your professional identity today. I'll catch you in the next one.